Moving on, we have reached the last session, the panel discussion on going concern, ECL and revenue over a period of time. I'll now like to call upon the panelists, CA Manoj Fadnis ji, CA PR Ramesh ji, and CA Veni Thappar ji on the dais. I'll also request our moderator, CA Vivek Newatia ji, Joint Secretary, ACAE, and Chairman, Accounts and Audit Committee. I'll introduce our panelists, CA Manoj Fadnis, past President, ICAI. He is a former ICAI President and ex-President of CAPA, is an expert in corporate laws and accounting standards. He has contributed significantly to company law reforms, served on numerous national and international boards and committees, presented over 1,000 technical papers, and holds directorship in listed and unlisted companies. Request everyone to kindly give a round of applause for CA Manoj Fadnis. CA PR Ramesh, former Chairman, Deloitte India and Independent Director. He is a former Chairman of Deloitte India and ex-member of Deloitte Global Board, has 40+ years of experience in auditing and governance. He serves as Independent Director on board of Air India, Cipla, Nestle India, L&T and others. Awarded the Best Independent Director Male for 22-23 by Asian Center for Corporate Governance and Sustainability. Past President in ACAE. CA Veni Thappar ji, she's an independent director, a senior partner at Vivek Thappar and Company, a distinguished chartered accountancy firm established in 1965. She brings over 30 years of experience in statutory and internal audits, taxation, corporate law, FEMA and RBI matters and information systems. She serves on the board of several prominent companies and has previously held key directorships in major public sector and private institutions. An active speaker, she contributes regularly to discussions on banking, financial sector reforms, governance and emerging economic challenges. I'll now request CA Vivek Newatia ji to kindly take the session forward.
A very good evening, everyone. We are towards the end of this very intensive workshop, I would say, since morning. We discussed a lot of topics, ranging from sampling to audit strategy to planning, and I think, of course, the last session on how to report when it comes to audit reporting. I think this will be another session. We were discussing just before the panel started as to how should we approach this session. Should we go by the questions which are there, very technical? But we then thought, let us go very candid. I think let us have some questions which are very normal and have some questions from the audience as well, so that we can make it slightly light after the intensive sessions that we have had in the past 5 sessions. So, as we know, the 3 topics which we are proposing to discuss is going concern, expected credit loss, and revenue over time, and revenue recognition principles. So ordinarily we would, as chartered accountants, feel that these are just accounting topics, but we as auditors know the pain when we come to discuss these 3 issues, I think. When it comes to management estimates with respect to these 3 topics, I think, and all the 3 topics involve forward-looking judgment, management estimates, uncertainties, and these 3 affect the performance and net worth of the client significantly. And when we discuss with the client, most of the clients would say, what would you say? What would you advise me? They are also sometimes clueless of how they would apply these standards or these accounting principles. So I think the first question to all the 3 panelists that would be there, I think all of you can choose either of the 3 topics. How should we as auditors address the requirement of going concern, expected credit loss, and revenue over time? How should we address the requirements of the standards of auditing when it comes to assessing the risks relating to these 3 principles? Ma'am, I'll start with you first. So you can choose any topic which you prefer, and maybe you can discuss on how the auditors would address this risk.
So, as we had discussed prior to entering this session, anybody who starts on going concern can go on the going concern from now till eternity. So I think I'm going to leave that to you, Ramesh ji. So typically, I think I'm going to pick up a little bit about, I think all of us will have to supplement, but I'll pick up the ECL because that's going to be the first thing that's running in everybody's mind, and also because at this point of time I have the pain of handling this issue vis-a-vis, the fact that ECL is now going to come into the banking reform starting from next year and things like that. So we have been having extensive understanding and discussions on modus operandi, on what to apply, how to do it at even the audit committee levels in certain organizations. And my perspective to this would be that from two angles I'm going to speak. Whenever the auditor has to take any decision on anything, the understanding has to be that the auditee has first put a framework in place based on which the auditor will ultimately evaluate something. My understanding here is that the framework that is being used or will be used or is going to be used in certain organizations where it's yet to happen, the involvement of the audit committee level, from the CFO to the audit committee level, is not as high in most organizations as the people working under them in the implementing segment. And because of that, there is a disconnect between what should happen, what should be the framework, what should be the way in which something is to be understood, documented, implemented, calculated, consistently applied, and then finally put into practice, based on which the auditor can then go ahead and understand whether they have picked up the entire process in the right way, whether the accounting standards have been followed, whether there are suggestions or anything more that needs to be done. I understand that some auditees might not want to have the, or may not have the understanding of how to go forward. I think that's an easy situation for the auditors then, because whatever you say is final. The problem starts when the auditee is definitely in the know-how of what they want to do or how they want to go about it. They also want to put a framework in place, but there is a mismatch between what is legally, ethically, and properly required to be done, not so much because of the ethical or the intent issue, but more because of competence issues in many, many cases. And that is where the auditor finds a challenge, because what is conveyed to them and what they analyze is not always on the same page. So with that, I think we'll have smaller sessions, and
yeah, okay.
You can continue on my topic or go on a new one.
Okay, thanks. So thank you. Been a great pleasure to be part of this panel. Thanks to NFRA and thanks to ACAE. You have already given the going concern to him and addressed on ECL.
Sorry.
So I'm left without a choice on revenue recognition. And your question is on revenue recognition, Vivek, broadly. Not with respect to any specific circumstances, but you believe that this is where there is a lot of management judgment involved. So quite right. I mean, in terms of what we have in 115, it is revenue. So it is based on the contracts that there is between the auditee and the customers, and basis that contract, like what we have in 115, the 5-step models. So you identify the components and then you allocate the consideration to the different components, and that requires a significant amount of judgment. And quite rightly, there could be different views. But what I believe is, what is important is that the auditor should carry out the entire process, see that the proper judgment is made, and document that judgment, because invariably, and it would happen more so in the circumstances of Ind AS, where there's a lot of judgment involved, the judgment of one person may differ from the judgment of the other. But so long as the auditor has applied his mind to that situation, taken a judgment, formed a judgment, and documented that, and that judgment is a reasonable judgment, so I think that should be good enough for an auditor to carry out. However, it is always possible that, particularly in cases where, say, in real estate industries, or where you are applying, whether it is the transfer is, as we say, at a point of time, or performance obligation is being completed over a period of time. So there could be issues and there could be matters which may require more deliberations, but I'll come to that later on. Coming back to that first question on ECL, so I fully concur with what CA Veni mentioned on that. Particularly in banking sector, the banks are yet to go on Ind AS. ECL is more in the case of non-banking finance companies. So NBFCs are quite varied in terms of their size. So you may have smaller NBFCs, but they are listed, and because they are listed, they are following Ind AS. But they may not have all the capabilities which are required for carrying out the expected credit loss, the models as envisaged under 109. But in case of banks, the banks have more robust systems over a period of time. The banks have been, though banks have not migrated to Ind AS, but they have been preparing the memorandum financial statements based on Ind AS and have been submitting it to the audit committees, to the boards and to the Reserve Bank of India. For last several years, they have a robust risk management systems, risk management committees, and the competent staff to carry out to find out the probability of defaults and then therefore assess what is the expected credit loss for the different loan segments. So I think in case of banks, the problem for the auditor may be less. Of course, the audit procedures remain the same. But in case of NBFCs, I appreciate there could be difficulties in terms of the NBFCs themselves not having the competent staff to carry out the entire exercise of measuring the loss models in a manner in which it is required in the standard, and therefore the auditor would be put to a little higher degree of difficulties. But be that as may, having accepted the audit assignment of a NBFC, these are matters which the auditor will still have to carry out and satisfy himself about the correctness or the otherwise of, with respect to that ECL model. So I'll pause here and pass it on to you.
Thank you. I'm not sure I can add too much, but nevertheless, let me first give a caveat. You know, in the slides which you have seen, they said these are not the views of NFRA, but of the presenter. I was also introduced as past president of ACAE, so my views, these are not the views of ACAE, but the views of the president, of the speaker. Having said that, I think all the three topics which you have identified, they are different in each way. Revenue recognition deals with measurement. Sorry, with recognition. Of course, there is a measurement component in it. ECL is all about measurement. It happens later. Going concern is about assessment and a prediction of the future. So there are three different things. The degree of subjectivity is lower in revenue recognition, higher in ECL, and the highest in going concern, because again you're looking into the future. Now let's take the first one, revenue recognition. And I'll also touch upon real estate very quickly. Before we came on to Ind AS and 115, etc., we had AS9 as an accounting standard on revenue recognition. There were three principles in that standard. The first principle was, did you transfer the risks and rewards of ownership? It's a very key test, because you can do a lot in form, but if in substance you have not transferred the risks and the rewards, you can't recognize revenue. The second was, this condition was subject to two other conditions. There should be no uncertainty regarding measurability. There should be no uncertainty regarding collectability. So if collectability was uncertain, you did not recognize revenue, even though you have transferred risks and rewards. If you could not measure with accuracy, you did not recognize till you had certainty or reasonable certainty about the accuracy of measurement. Have those principles gone away? I don't think those principles have gone away. Even in Ind AS 115, it's further refinement of it to say, okay, if you have one consideration, how do you split, etc. But why that refinement was necessary? Because in the modern world as to how contracts started. Now it is not based on, one thing we should all be clear, it's not based on collection, it's not based on invoicing, it to some extent is based on milestones, if you have a contract. Now when you do that, some contracts will say that I can terminate the contract at any time. In which case, when do you recognize revenue? And how much? If the contract specifies that if I terminate the contract any time, but will pay you for what you have done, you are entitled to recognize revenue. Because even a half-completed building without a roof may be of no use to somebody, or half-completed software project. But if his contract says that I can terminate, but I'll still pay you for this portion, then you don't, I think we can recognize revenue on that. So I'm just giving some uncertainties. When it came to real estate, the complexities were even more. What happens in real estate is, let's say you put up a 100-story building, which is common now in Mumbai and other places. What gets sold first, as the term sold, is the 100th floor. What gets sold last is the ground floor. What gets constructed first is the ground floor. What gets constructed last is the 100th floor. What is the revenue you recognize? Do you recognize completed contract method? Do you recognize percentage completion method? Do you recognize when possession is handed over? As opposed to another where you have a huge gated community where there are individual row houses, each is separately constructed and handed over. So the challenges are different in real estate. There, two tests must be applied broadly. One is, does our accounting reflect the economic reality of what is happening? Fundamentally, we should try and reflect the economic reality of the commercial activity. That means, if I have entered into all the agreements and I have received all the money and I have not constructed one piece, there may be commercial activity but no economic activity in terms of or physical activity, and therefore we need to align the two. The second also is the fact is, can any of this undergo a reversal in some form? Now it's highly likely if I've taken money, signed an agreement, I don't construct, isn't it reversible? So that is why a percentage completion, when you're looking at the entire, how much have I sold out of a total square feet area to the total square feet area, and how much progress I've made in construction, could reflect both a combination of economic reality and a commercial reality. That's so far as revenue recognition goes. ECL, we could have various models. There are several ways to skin a cat. What is the purpose? We moved away from an incurred loss model to an expected loss model. The purpose is to determine what is the expected loss and make a provision for it. Therefore, these models are not the end in itself. You need to be able to assess whether you, in addition to the model, you get onto individual cases also and assess failure at a probability at higher rate than within the model. You need to look at clusters. I think one of the good guides for auditors and audit committees is the NFRA guide on ECL. I would urge each one of you to look at that also. And audit committees to also ask those questions. The third, the most difficult, is going concern. It's like asking each one of us how long I will live, or whether I will live in perpetuity. We all like to believe that we live in perpetuity. Even when you are ill, we think we are going to live forever. The same thing with corporates. We can, as she rightly said, Madam rightly said, we can talk till the cows come home till on going concern. But the fact is, communicating to the user of financial statements that the fundamental accounting assumption on which these statements are prepared is flawed. And there is a significant doubt, and therefore there is a significant uncertainty. Now this test is challenging. I still remember, I was in Kolkata at that time, and I was the auditor of Union Carbide when the Bhopal gas tragedy happened. You have thousands of crores of claims. If you'd add up the claims and then look at the net worth of the company, the question of going concern is in doubt. Is the concern still running? Of course, the agricultural products division and that plant is not running. But is the company still running? The company is still running. So the purpose you have to understand is to communicate to the user of the financial statement that there is a doubt regarding the ability to. Very rarely you can come across a situation and say it will not continue as a going concern. Even in situations, if I give you an illustration, for instance, you are a brewery and there is a license. Suddenly the government changes in a state and they say from today onwards it's a dry state. Your business comes to a grinding halt. Then you may still have to take a view, is it a going concern or not a going concern? You are profitable, you have money in the bank, you can still pull on for such time, the government may last for 5 years, and after that, question mark, maybe a new government will turn around. So, hugely judgmental, and I don't think there's a yes or no answer, and we can go on. I'll pause.
So, I'll just add on to the interesting issues which he mentioned about real estate. And I recall way back in 2011 and 12, we sat down together in Hyderabad and we had prepared this guidance note on revenue recognition of real estates, which was a combination of AS7 and AS9, and very interesting examples given in that guidance note. And thanks to a lot of efforts what Mr. Ramesh had put in, that guidance note brought in different scenarios. Now, when Ind AS, we migrated to Ind AS, a similar guidance note on Ind AS for real estate companies was brought out, but that was when we had Ind AS 11 and Ind AS 18. And when we migrated from Ind AS 18 to Ind AS 115, which is actually a combination of Ind AS 11 and Ind AS 18, I believe there was some not really particularly from the real estate sector. One issue which came up was that Ind AS 115 is in a way parameteria with IFRS 15, which was a combination of IAS 11 and IAS 18. But Ind AS 11 and IAS 11 were not the same because there was a IFRIC 15 and we had departed from IFRIC 15. So the impact of that is what he just mentioned, is where there is a reversal of revenue possible. So if you have a real estate contract and if the buyer cancels the contract, then you are required to refund the money which you have received. And as the RERA regulations provide for, the companies may actually retain maybe 10%, 20% of the booking price. So the issue comes up is, if I have received 60% of the total price, can I recognize that revenue? So more likely the answer may be that since you can retain only 20% and not the entire 60%, so this is the amount which is likely to be returned. So that is where the issue with respect to accounting on a percentage completion basis, which is performance obligation satisfied over a period of time or at a point of time, actually really comes up in context of 115, and that is where the auditors would be required to take a lot of judgmental calls, looking at what are the regulations, what are the contracts. So it is how the contracts are written and what is the specific permissions which have been given by the RERA, and analyzing that, you really need to decide how the accounting would take place. So yes, 115 poses many more challenges. But what I believe is that the guidance note which the Institute brought out way back did not really contain this feature. Otherwise, all other aspects are really still there when you look at 115. So in terms of the initial matters relating to measurability, collectability. So in a way they are still there in 115, but it has one more feature that you cannot account for a revenue which is likely to be refunded, and that is where the issues in real estate come in and where the auditors need to take a judgmental call.
Thank you, sir. I think very detailed deliberations on accounting for revenue for real estate industry. On a lighter note, sir, we thought we were not discussing standard numbers, but to make it not technical. But I think I will ask Veni ma'am a very relevant question here. Since she has been on the board as an independent director on various public sector banks and various corporate entities, whether you have had any interaction with the auditors on the revenue recognition standard, and what are the kind of discussions that you as the ACB chair had with the auditors, and how have you drawn a comfort as the ACB chair that yes, the numbers are right?
Okay, this is the very basic actually. If an audit chair, or for that matter the audit committee, is not interacting with the auditors at least at the time of the result declaration to get a comfort on basic revenue recognition models, I think we are all failing our duties. So yes, as part of my duty, I have also entered into these very candid conversations with the auditors, not only through their ordinary presentations. So I'll give you an example of something that happens in one of the organizations where I've been on the board. So typically there's a proper model of revenue recognition, there's a contract, they are selling their products to their customers. Everything is in place the way it should be. The revenue recognition model is as it should be. But, and it's a watertight contract. But what usually happens as a trend is that after a year or 2 years, and they are continuing customers of that organization, they tend to come back to the company and say that, okay, we want a discount on what has been also. So we are continuing, we have decided to give you an order of X lakh pieces or a periodicity, whatever may be the reasons or the style of contracting for that particular revenue. They would come back, some of them with different parameters. Some would come back and say that, look, we know that your raw material has come down and we want a percentage of that passed on to us to bring down our costs. Some would simply come and say that, you know, we are not remaining very competitive in the market, we expect you to give some discounts. Now, these discounts typically are not agreed, accounted, they are not pre-established through any contract. Yes, they're usually volume driven, they're loyalty driven, but they do come back. When they come back, the decision whether what has been asked for will be given in totality or not is also discussed at point of time. So should the organization recognize the entire revenue at the first level? Should we go through a provision basis? Should we at all go through anything when we do not know whether somebody will come back to us and ask us for discounts? Is that over-provisioning? If we don't do it and the customer comes back 2 years down the line and we want to continue with that customer, it's a loyal customer, we have good margins, so we do want to extend that credit, so is that wrong? Now, business is going to work like business. Ethically, right, but still work like business. I can't, sitting in an audit committee, tell the company that you please do not have discount patterns with your customers, or they can't come back tomorrow and ask for something. Business will have its own way of looking at things. They have to maximize the business. So ultimately, that is where, you know, the auditor would come in and they would discuss with us. They would tell us that, you know, the revenue has been recognized here, but periodically at that point of time, we are also recognizing on a very scientifically discussed and decided basis that this customer usually over a period of this time, over this much of revenue, this much of, they extrapolate the data into the statistical sampling that sir was talking about last time. Then they come up with a figure that this is what we should use as a provision against the revenue that has been recognized at that point of time. And the audit committee interacts with them at every periodicity that it decides fit to understand how much of that provision gets used and how much of it gets reversed. Because there was a concern, if a listed company is under-providing and over-providing, and that is affecting its share price in a particular way, are these also ways and means in which we are sort of driving the share price high and low? And I'm not getting into UPSI, and I'm not getting into people who are not supposed to handle or deal with shares at that point of time, dealing with them. But we are, I mean, if the auditor is not looking at it in that depth, and if the audit committee is not supplementing that viewpoint and looking at it in equal depth, we can even use these tools. They become tools rather than becoming, mannerisms of stating true, correct, fair, dependable financials. Instead of that, these kind of things become tools in some point of time to drive certain things, including share prices. So I think what is very important, it's not the work of the audit committee to lay down everything. It's important that the audit committee ensures that what is laid down, there's an assurance. And of course, based on the people who are sitting there, if they also have the technical capability, they understand that what is being laid down is ethical, right, doable. And ultimately, the implementation has been correctly tested by the auditors. I do interact with them, the whole audit committee interacts with them to understand that they have also run this on a proper statistical process and have not done this arbitrarily.
Thank you, ma'am. Very comprehensively explained. Sir, Manoj sir, I'll coming to you on the going concern issue. Now, today we are seeing a lot of companies going under IBC. There are certain companies where we see that notices have been received under IBC framework by certain entities, and the insolvency proceedings have not been initiated. There are certain cases where the insolvency proceedings have been initiated after the balance sheet date, but before the signing of the financial statements. And then we are required to validate the going concern assumption, as Ramesh sir also pointed out on how do we validate the going concern assumption. There could be a scenario where the auditors have certified that the going concern is not affected, but the case gets admitted under IBC post the signing of the financials. And therefore, it raises a concern on whether the financial statements that were signed off without even giving a disclosure of MUGC, material uncertainty relating to going concern, will that create a challenge from an audit perspective? What would your views be on companies which may potentially get into IBC or which have gone into IBC?
So first is the auditor's opinion is a dated opinion. So it is as on the date on which the financial statements are approved by the board. Normally it is the same date. And therefore the opinion is with respect to the balance sheet up to the facts which come to the knowledge of the auditor up to the date on which he signs the audit report. Thereafter what happens, and thereafter if the IBC proceedings have been initiated, not initiated, or the company is wound up, so they are different, subsequent facts. So the auditor, in my humble opinion, is responsible up to the point of time when he issues his audit opinion on the balance sheet, as on the balance sheet date, read with the events occurring after the reporting date as per Ind AS 10 or AS 4 as the case is. Now that is point one. Second is, merely because a notice is received does not mean that the going concern is under doubt. So there are number of factors which are required to be considered by the auditor, and I like the example which he gave is you're predicting your date of death, which is always uncertain. But nevertheless, for assessing the going concern, you look at the financial viability of the company, you look at whether the loans are being repaid, whether there is a sufficient cash being available to the company, there are sufficient orders available to it, there are no regulatory matters going on which might close the industry at that point of time. So these are the broader aspects which are to be looked into by the auditor to satisfy himself or herself with respect to the whether the company is a going concern. Now, the IBC proceedings is one of the factors which is bound to be considered. And as we know, under the IBC laws, it is not necessary the company is wound up. It is possible that the management is changed. So the company continues, the corporate entity continues, but with a different set of management. So depending on the facts, the auditor is required to, as guided by the standards, required to give his opinion.
Sir, just a follow-up question here. Would you prefer that there are certain disclosures which need to be made to the users of the financial statements, and would the auditor require to validate that note?
So it depends. I mean, if the going concern is not an issue at all, then there is a mere statement in the that the financial statements are prepared on the going concern basis, and then the auditor is not required to make any separate disclosures. But assuming that there are factors basis which there are uncertainties, and basis the matters discussed with the management, the business plans, etc. So there is an uncertainty and there are mitigating factors available. So then there is a requirement for adequate disclosures in the order, in the financial statements, and with suitable disclosures in the audit report.
Thank you, sir. Any follow-up questions here? On
relating to guidance note issued by ICAI following Ind AS. But I understand the guidance note was issued sometime in 2018, which has later been withdrawn by the institute.
So that is because earlier it was basis Ind AS 18, and when Ind AS 115 was notified, that guidance note had to be withdrawn. I mean, I suppose that was the sequence. So earlier it was 11 and 18, Ind AS 11 and Ind AS 18 which were notified. And 1/4/2018 onwards, it became converted into the applicability of the standard was 115. So at that point of time, the earlier guidance note was withdrawn. And there is a very useful education material on 115 which is brought out, giving around 80-90 questions and around 8 to 10 questions with respect to different industries, including the real estate industries.
Yeah, that I have already gone through, but in replacement of the guidance note, is there any other material issued by the institute for the
No, there is that education material. Education material is there. Apart from that education material, there are that ITFG bulletins which were issued. So that would also cover some of the questions on 115. But these were the two supporting materials which were issued by the ASP.
yes, Vivek.
Yeah, my next question is about ECL we were talking about. There has been hue and cry about ECL on fixed deposits. So if you can enlighten, like, because whenever we talk to any management, any financial asset, ECL has to be checked and provision is required or not, that can be ascertained. But on any given day, whether ECL on fixed deposit should be there or not, and because there has been a lot of discussion throughout India on this, so if you can just enlighten on that.
Fixed deposit with respect
With banks.
So this has been very rightly brought out for discussion in that paper issued by NFRA. And see, there is a sovereign risk. So we say the sovereign risk is zero. Well, globally they may not say that the sovereign risk for India is zero, but normally you say sovereign risk for a country is zero. For India it is zero. So any bonds issued by Government of India, you may not give any credit risk to that. But anything issued other than by the Government of India will have a credit risk. So even if I am a deposits with State Bank of India, and which we say कि सरकारी बैंक है ये थोड़ी डूबेगा, and rightly so, that is the belief. So there, make sure you have a ECL provision. To my mind, there is a ECL provision, but the quantum is less. The credit risk is very low. Does not mean the credit risk is zero. So I think that is the very appropriate issue which has been brought up for discussion through that NFRA material.
Perfect, sir. Thank you.
Deposits also. The sovereign risk, Manoj sir brought out very rightly. But if the deposit is in foreign currency, then that sovereign risk protection will not come. That is the bankers themselves accept it, that if it is not issued in the domestic currency, then you will have to look at it as and the other one point is also when you are looking at ECL, it is what happens is many times you have to see there is it has to be on a present value basis. The government actually in many cases apart from this, take the case of a government itself. What might happen is that many times there are so much delays in the government paying that. So if you look into that present value concept, from the probability of default may not be there, but from the present value perspective, then it comes cash flow perspective.
So, in context of what Kulkarniji mentioned, if you look at the Greece bonds, there was a lot of issue in Europe a few years ago that bonds issued by Greece and held by the European banks. So they had to make ECL provisions on those bonds.
Yes.
I think sir pointed out, Vidyadhar sir pointed out time value of money when computing the ECL. And let's assume it's a sovereign, it's a receivable from the government, where the probability of default will have to take it as 0.
Probability of default.
Will have
again you will have to actually look at many times these kind of things. Government rejects these cases also. There are many such cases. So if there are no such kind of experiences there, then what you are saying, probability of default becomes 0. Then your ECL become 0. So it is a case by cases. You will have to really look at it.
So like Sri Lanka, like a few years back, Sri Lanka had a problem. So if you have exposures to the Sri Lankan economy, so
there is a country risk. Once there's a country risk in place, then you cannot wish that away. Something has to be allocated.
Sir, my next question to Ramesh sir. Sir, we are talking about ECL, and we talked about sovereign risk, we talked about credit risk. And Fadnis sir also pointed out that in NBFCs, possibly the ECL models have matured enough or not matured enough. It's something, a debate which is always there. A question which arises is, if we look at NBFCs, they do have management bias sometimes, or they create some provisions over and above what is there in the ECL framework. There is always also a scenario where a parent company gives loans to subsidiaries which are loss-making, and we sometimes over-focus on the ECLs which are required to be made on loans to subsidiary. Considering these two aspects, these are two different aspects, I would request you to throw light on both these aspects. One is whether how these management the overlays should be disclosed, because there's no requirement as per this present standard requirement to disclose how much is the overlay. Should there be a requirement? How should the auditors evaluate the management overlay? And second is, should we, as India, move from a solo level financial statements to a console level financial statements, as this is a practice in some countries abroad? Should we therefore look at should we look at consolidated financial statements and therefore ignore the ECL on loans given to subsidiaries which are loss making? And therefore, should we therefore look at consolidated financial statements only in India?
Okay, so let me start with the first one. You use the term management bias. I don't think that's too strong a word. In terms of bias indicates a negativity. But more important here is, typically accountants, including auditors, get carried away by a model. And therefore they believe that when you apply a model, the result of the model is the most appropriate. Even if you recall, RBI, even in the past, when we were on an incurred loss model, said that the prudential norms were only the minimum. You are duty bound to exercise your judgment and make additional provisions where required. Therefore, I believe that even in NBFCs, management should go beyond an ECL model, look at components within that, and then, if required, make additional provisions, but not reduce the provisions on any of the components. So that perhaps settles this whole issue of, and at the end of the day, as an auditor and as preparer, what is your concern? One is, of course, the time value of money. The second is the loss. Are you covered for the loss? Ignore the arithmetic involved. Arithmetic is only a means to an end. Look at the end result. And look at your provision coverage ratio vis-a-vis what your profile of your portfolio is. Do back testing to see how has been the experience vis-a-vis what you provided and what really happened. Those are typical tests, just like you do back testing when you're taking a forex cover. You say, how much should I cover my forex in a time of volatility? Are my decisions right, etc. So back testing is one of the things, how good are you in forecasting and doing it. And that is something which I would. Now, dealing with your second subject. A subsidiary is a standalone legal entity merely because the parent controls it. There is no guarantee that the parent will step in to fulfill the obligations of a subsidiary. Unless you have an assurance that a subsidiary has given a corporate guarantee of the parent, you are duty bound to look at the subsidiary in isolation and make provisions for it. You are not expected to, in my view, and it would not be appropriate to extrapolate and say, this is part of a very large group, which will therefore not default. There have been enough cases of restructurings which have happened where you have had to take a haircut, even though it is part of a large group. And therefore, I don't think we should look at consolidated unless there is a corporate guarantee. If there is a different view, I'd be happy to listen to it, but that would be an adventurous view in my view.
I like that rider.
He was actually, I think, looking at was, like when India is one country where there is this separate financial statement and the consolidated. Both are being looked at and statutorily required, and huge amount of paperwork is there. A lot of things are there. And only in case of one standard that exemption is given, operating segments. Like if you are giving in consolidated, you don't do it here. So here he was saying there is the issue of whether it is a loan given by a parent to a subsidiary. In the parent's separate financial statement, we will spend enormous amount of time in actually trying to find out whether that ECL is there, not there, and the management also keeps justifying that no, anyway it is my son only, I am going to repay, get it and all that.
If it's a loan given to a subsidiary,
yeah,
ultimately what is it? It's for loss in terms of you're getting the cash back.
yeah.
So if your subsidiary is unable to pay you, what are you finally going to do? Either put good money after bad, or write off what you've given, right?
Yeah, so but that what happens is that subsidiary has put that money into all non-financial assets, and uska impairment to testing ho hi jata hai. And you do under Ind AS 36.
True.
If there is a operating business losses of subsidiary, they will capture.
Correct.
But in addition to this ECL which you are doing on the loans.
No, first again,
Yeah.
If it's the question of maybe I misunderstood the question.
Yeah.
If it's parent subsidiary,
Yeah.
in the standalone accounts of the parent, I have to provide.
Yeah, this is what is the challenge
In
he's
the
saying.
consolidated financial statements, that asset has come. Against that asset, I've already made a provision, so that will be neutralized.
Yeah, that will be neutralized.
That's all I'm saying.
Correct.
There.
Yeah, this is what is another thing. Yeah, extending that to even.
No, I only hope the
related
question won't get extended to going concern and all that. There'll be a going concern qualification, a subsidiary.
That is
Will you-
also another challenge actually. But let's leave that because it extends to related parties transactions also. Because the enormous amount of time is spent on looking at the arm's length between the subsidiary and the parent. That was his question, right, Vivek?
But in any case, I don't think we'll be in a position to shift completely from standalones to consolidated in the short run. I think we've had that discussion before. In India, the way the scenario is, we certainly need the standalone. Consolidated now, of course, is also needed from a very different perspective, and that is where the going concern can come
and
in.
it's also because dividend is declared from
dividend,
standalone.
tax,
So,
tax
to add to
payments,
that, and to add to what
remuneration,
she
you
said,
said.
The fact that Ind AS is applied on standalone financial statements. If you go back to the point of time when these were notified, there was a discussion going on at the government level, and because from 2010 to it was not notified till 2015, so there was in 2014 a suggestion given also from the institute that because of tax issues you are not notifying Ind AS, so let us make Ind AS applicable at consolidated level and do away with the tax issue. So that is how IFRS is implemented at console level. But then at that point of time, important to remember that SEBI said that even standalone are important.
Yes.
And because standalone are important, so you need to have Ind AS on standalone. And that is the point of time in 2014 when the Honorable Finance Minister notified, made that budget speech implementing the Ind AS. And that is when the ICDS came in subsequent to that. So the tax issues are addressed through ICDS. So that is how the importance of standalone will continue, at least in our country, for time to come.
Very well explained, sir. I think
Yes.
this year the finance minister has made an announcement that ICDS are proposed to be aligned with Ind AS. I am personally...
Which I don't think should happen. You need certainty in taxation. You can't go by a judgment. Ultimately you are paying taxes. So I believe so. New ICDS are required, like for say share-based payments, for intangible assets, for matters arising from business combinations. But ICDS have a role to play. I mean, that's my view.
And
if the ICDS had not come in, I think the 2015 would have gone 2025.
No, it would have gone to console.
No, what I'm saying is, like 2011, India's roadmap was stalled because the people said that, how will you treat for taxation? Tell me first. So that is how they said that we'll do it later. So in 2015, the best thing of that ICDS which did was, apart from that taxation certainty, it actually gave certainty to the India's roadmap. Because the people didn't have any objection to raise that, on the taxation front.
And personally, I don't think, I think it's very difficult for ICDS to align with Ind AS. Ind AS fundamentally thrives on the concept of prudence. And ICDS, as we know, has tax reasons for various...
Yeah, a slight, this one, Vivek. One of the reason the ICDS, why that alignment was required was, the ICDS, some of those are written on the basis of ASs which are old one, 2000 AS. So there is a difference between your fixed assets and all. Right. So that kind of alignment is what actually is required if the ICDS have to continue.
No, but ICDS also follows
like
the income
alignment.
tax law, like section 145A for inventory is different than what is there in AS2 and Ind AS2.
Those are the two major ones.
Like
which
section 43B, section 32 Income Tax Act, assets put to use. So these are certain fundamental differences in the tax concepts as against the accounting concepts. Correct. So you need, and I believe it is good to have definitive rules in taxation, and which is put in ICDS. So just to give another example, like for construction contracts, you say there should be a reasonable certainty. ICDS says 25% threshold. If you have reached 25%, there is no reasonable certainty, you have to start applying percentage completion. So that is in section that 43CA. So in that sense, it is good to have certainty in tax matters.
3-4 areas are there, there will be, the differences will be there.
Of litigation.
Many, and there are many sections which are there, they themselves treat those separately. But the point is in ICDS 1 to this one, if you see,
they are based on
that old AS11 and many of those things.
So
those
there'll be more of alignment issues, so that all the rules, acts, all the parameters, all the definitions start reading similar, and also some alignment for hygiene issues, basically.
Any quick questions from audience? I think we are coming close to the panel discussion. So
only one thing, because all of them are independent directors, still many of us has this question of TCWG. Who constitutes to be TCWG if have one-liners from all of you?
I think fair point. I think we can have one-liners from each of the panelists on TCWG.
The buck is bound to stop on the board. whether NFRA came up with the circular or it didn't, it was always there. The concept has not been brought in by the circular. The concept has only been reiterated, right? It's been sensitized, reiterated. Some things have been put into perspective. But the concept of those charged with governance was always there. In an organization, basically, I think, let me tell you what I think, how I read this. How I read this is that in any organization which already has its own organizational hierarchical pattern, the roles are definitely defined for every activity, and the ownership of every activity is already placed. I think what is required is a documentation of the framework so that the understanding of the person doing it, the person who is the owner, I mean the professional who's the owner, the committees, the board, everybody has an alignment in that framework. The auditors also identify who they feel as per the framework, are going to be the people with whom they will interact. You will certainly interact with everybody at every level to be able to achieve what you have to do. But is it okay to reach up to this point, and are you satisfied? Or no, you want to go to the next level? Should you go to the next level? Do you need to go to the next level in every case? In many cases, the auditors in their communication are actually stopping, despite the circular, they are stopping those charged with governance back to the audit committee again, because in their experience of the last so many years, the audit committee has been doing the relevant job that it needs to do. Earlier, it was just easy for the board to say that the buck stops there, at least for the financial segment. Why? Because those members are supposed to be financially literate. And bringing it to the board may bring in some kind of discussion that may be unwarranted. It may not be needed. It might be educating some more people on the board. But what the board did not say but got interpreted, and what the the law does not mean but got interpreted, was that you don't have to go to the board. You should not go to the board. It was never written like that anywhere. Committees under the board are formed for the very purpose that some people can brainstorm in more detail, in more discussion patterns. Board can't collectively do that all the time, otherwise nothing will get done. So that is why they were charged with this. But the board never said that by charging them or giving them this space, we have done away with our authority and you can't come to us. Similarly, the auditors were never told that you can never approach the board. It was just a norm that got interpreted almost like a law. So, or I won't use the word law, like a rule, right? And that seems to have now been put back. I mean, the only thing that has happened is that somebody has woken up and said, look, I'm giving you a wake-up call, put it back into perspective. Correct. That's it.
I fully agree with what she said. So, it is, see, it depends on the size of the board. Smaller boards with, say, 3 promoted directors and 3 or 4 independent directors. So, generally, my experience has been that on such boards, the independent directors, all independent directors are members of all the committees, or they come and attend the board meetings, the audit committee meetings where the results are being there. So in a way, all the directors are involved. Even in some of the larger boards, the other independent directors also attend the audit committee meetings. But I think this is a good development that the matter is again brought up to the notice of the board, that it is the board's responsibility being discharged through the audit committee. So while the board is entitled to rely on what information is being brought to the board meetings by the chair of the audit committee, which has discussed with the auditors, but ultimate responsibility is of the board. And that is being brought out clearly and being brought into focus, brought into discussion. And the board is suddenly waking up to the fact that it is the board's responsibility and not the audit committee's responsibility. So it is good that the auditors would now be telling the boards that it is, while we are discussing with the audit committee, it is the financial statements are prepared by the management, are being approved by the board and then being signed by the auditors.
Ramesh sir, your quick comments on this, please.
My quick comments, before I make comment, I have a request for the auditing community and the accounting community. Having retired from the profession 6 years ago, please remove the word charged from that. Those charged with governance. We are those entrusted with governance. Okay, get the auditing standard changed. Now, having said that, I think we need to understand why we are in this situation today. Madam rightly explained also. Auditors stopped at a certain level and assumed that everybody else is aware of it. The second, more important, you talked of ultimate responsibility of the board. You cannot in all situations assume it is the ultimate responsibility of a board. Every independent director, as you know under law, is responsible for all matters which he becomes aware of through board processes. Now, if I am an independent director sitting on the board not a member of the audit committee, if the matter has not come to my attention through board processes, I don't get to see the auditor's presentation, nor has the chairman of the audit committee communicated to the board. In my view, I am not responsible. So therefore, when corporate failures happen, how do you hold directors responsible? You can hold them responsible only if you ensure that they are made aware of through board processes. And that is why it's important to ensure that all those who are charged with governance, and to answer your specific question, can tell you who is not charged with governance, though they claim to be wearing a governance hat, is a whole-time director who is an employee. He is management. Now, it's impossible to say I sit in the board and wear a governance hat. I am the management. At the end of the day, I'm director manufacturing. I will not blow the whistle on my colleague. I'll sit in the board there. So exclude them. Have all the others sitting on the board who are part of governance been informed. An auditor needs to be satisfied. There are different models of it. One, an auditor can directly communicate with all. Other is he can communicate with the audit committee and ensure with evidence that the audit committee has communicated all those matters to the board by seeking that sort of written confirmation from the board or the company secretary before he signs off on the financial. Third, practice in some companies, when financials are discussed, the entire board is present, invited to the audit committee. It may not be logistically possible in some cases, but the simple principle is communicate to all those who are involved, then only you can hold them responsible. And there have also been cases, NFRA would have noticed that, in many cases, even audit committee does not give the auditor time. So you deal at the lowest level and then you say, I have told so and so. It is not right, absolutely not right. I think we need to understand the spirit of what is being sought and deal with it.
Thank you, sir. I think very insightful and sharp comments made by each of the panelists. Sir, I think just last question, please. Last one question, please.
First of all, I must confess that I am not a chartered accountant, neither I am an auditor. So I am just the odd man out. So I have some academic questions. First thing is, if we don't follow going concern basis, what method we follow? Second one is, my question is that conceptual framework that released by Chartered Institute, 2-3 pages written on estimate and uncertainty. Are they related?
Taking that second question first. So there's a very fine statement, and I'm sure you would have read that several times, is estimates are one of the limitations of the financial statements, but they by themselves do not make the financial statements unreliable. So this is something which is there in our AS5, Ind AS 8, and somewhere in the framework also. So if we say the useful life of a machine is 15 years, it is a best estimate. If there are proper repairs and maintenance, the life may be 25 years. If it is not maintained, it can 5 years also. So estimates is a limitation that of the financial statements, but that by itself does not make them unreliable. So I think that is the second. So estimates would lead to, so that is the best estimate. So in that sense, if my estimate of a particular...
We talk about estimate of uncertainty of estimates.
Well, I think once the estimates are made rationally, there would be uncertainties, but what is important is that this estimate, so like how do you make...
Estimation uncertainty.
Estimation has an inherent element of
uncertainty.
The second thing I was asking, if
on
we
the
don't,
first the liquidation.
If we don't follow going concern basis.
So normally what is said is you follow the liquidation accounting.
In more or less in many PL there are two sections: continuing operation, discontinued operation.
Sir, so I think we will take it offline, please, if that's okay, because of the time limitations. And on behalf of ACAI, I think we'll just a round of applause for all the panelists for the insightful and sharp comments. Thank you, ma'am. Thank you, sirs, for sparing your valuable time. It was a wonderful discussion on ECL going concern and revenue recognition. Thank you for giving your inputs. Thank you. Thank you.
Thank you so much for that panel discussion. Moving on, I'd like to invite Shri Shyam Tong ji to come up on the dais and felicitate our panelists and moderator. I'd like to call CA Neeraj Harodia ji, President ACAE, to come up on the stage. And I'll request Shri Shyam Tong ji to kindly felicitate CA Neeraj Harodia ji. Thank you. I'll now request, and thank you so much. I'll now request CA Neeraj Harodia ji to kindly present a coffee table book and memento to CA Veni Thappar ji. I'll request CA Biswaranjan Sutar ji to kindly come up on the stage and present the coffee table book and memento to CA Manoj Fadnis ji. I'll request CA Mohit Buteria ji to kindly come up on the stage and present a memento and a coffee table book to our panelist CA PR Ramesh ji. I'll request Shri Shyam Tong ji to be present with us on the stage. And I'll request CA Vivek Agarwal ji to kindly present a coffee table book and memento to Shri Shyam Tong ji. I'll now request Shri Shyam Tong ji to kindly give the concluding remarks and propose a vote of thanks.
So when in Rome, do as Romans do. नमस्कार, शुभो संध्या. हमारा कोलकाता ऐसे उपस्थितो होते अत्यंतो आनंदितो. So as Anjan told us today, we are celebrating that linguistic diversity. It all started from Bengal. So good evening, esteemed full-time member Jaiswal sir, ACAE President Neeraj ji, distinguished speakers, honored guests, and dear participants. A very good evening to all of you. Before I begin, my humble request with the participants is there is a Slido feedback coming your way. So please do respond to that. While I'm speaking, you will be receiving, feedback on the Slido. The code is 28-27705. 28-27705. Do respond to that. That's very valuable for us. Slido.com. Yeah. So I'll be giving some concluding remarks as well as vote of thanks, a long list of speakers and everybody who was involved. As we conclude today's outreach program and workshop, it is very satisfying to note the depth and the richness of the deliberations we have witnessed today. Now, this workshop showcases collaborative success of NFRA with ACAE in knowledge sharing. It has also demonstrated that the practitioners can be equipped with essential tools, best practices, and regulatory updates. All this to strengthen audit quality and financial reporting in India. We extend our profound gratitude to our chairperson, NFRA, Nitin Gupta sir, for initiating this outreach series, creating a better financial reporting system, focusing on SMPs, and also joining us today here. We are also grateful to NFRA chairperson for his inaugural address and visionary guidance, which set the tone for the profession's role in strengthening financial reporting and corporate governance in our country. My sincere thanks are also due to NFRA full-time member Jaiswal sir, whose gracious presence and thoughtful contributions added immense value to this program. Sincere gratitude to Neeraj Harodia ji, ACAE President, for delivering his welcome address. The sessions on audit strategy, documentation, primer on ROMM, audit sampling, and concluding audit have provided practical insights that are directly relevant to the challenges faced by small and medium practitioners. The panel discussion, I think it was the highlight of the day, and I was telling the esteemed panelists that when stalwarts come together, clarity emerges. Wonderful on going concern, ECL, revenue, and valuable insights into these areas, skillfully moderated by our Vivek Newatia ji. Now, their ability to address evolving challenges like ECL modeling under economic uncertainty and going concern assessments amid market volatility was truly commendable, making complex topics accessible and actionable. We are thankful to our esteemed speakers, Nilanjan Paulji, Ajit Vishwanathji, for delivering insightful sessions and constant encouragement to uphold global best practices in auditing. Their presence has added great weight and perspective to today's deliberations. I stand here to extend my sincere thanks and appreciation to our NFRA officers. A round of applause to Executive Director, NFRA, Arun Kumar ji, our Principal Consultant, Vidyadhar Kulkarni ji, and CMA Anjan Ganguly ji for delivering such engaging and practical sessions. Your efforts have provided every participant with meaningful learning and actionable takeaways. We extend our sincere gratitude to the distinguished panelists, CA Ramesh ji, CA Manoj Fadnis ji, CA Vini Madam, and Vivek ji also for the profound insights, practical illustrations, and strategic guidance on the vital topics covered, I'm sure which will enhance professional audit and compliance practices. Our special appreciation to again Mr. Vivek Newatia for adeptly facilitating a most engaging and productive dialogue. Our heartfelt appreciation also goes to Neeraj ji, Vivek ji, the entire team of ACAE, their executives, members for their valuable support in making this workshop possible. I request a big round of applause to ACAE team. Yeah. I also stand here to thank entire NFRA team, right from our chairperson, Jaiswal sir, all those who are present here, and those, faces, camera ke piche jo log hote hain. So I stand here to thank all of them for jointly organizing this with ACAE. My all praise and appreciation to our masters of ceremony, Rashmi ji, Manish ji, Ayush ji, and Roshan ji, for seamlessly guiding us throughout the proceedings. I also wish to acknowledge with deep appreciation efforts of our venue host for the excellent arrangements. Thank you. May kindly be extended to the venue host, Neeraj ji. Finally, a very special thanks to all our esteemed participants. A big round of applause for all of you. And we are informed that the participation has been from, across places like Guwahati, Siliguri, Dhanbad, and Durgapur, Asansol, even Delhi. So a big round of applause and thanks to all of you for not only attending, but making this a very vibrant and interactive workshop. Thank you very much. As we carry forward these learnings, let us reaffirm our commitment to upholding audit quality, strengthening financial reporting integrity, and advancing the profession's role in our nation building. दोनों बाद सोबाई के हमारा भविष्योते पुनर्मिलितो होवार ओपेक्षे आची. जय हिंद. We wish to see you again. Thank you very much. Please give your response on Slido to the feedback questions, please. Thank you. Yeah.
So, friends, our respected whole-time member is here and all officers from NFRA is here. So, please give a big round of applause for all of them. And definitely, this dream cannot become true without their unconditional support. I can tell you in all the way. And जिस तरीके से इस पूरे प्रोग्राम को 10 बजे से 6 बजे तक कंडक्ट हुआ, so I think sir we are really overwhelmed, and I am telling you this morning around 25 past presidents of ACA were here and all were saying that they can't believe that this program is conducted with regulator. So this way, so definitely sir we will look forward, and definitely because हमारे यहाँ president हर साल change होते हैं, तो I expect कि जो हमारे next president आए, again they get the opportunity to work with NFRA, and definitely this relationship with the Eastern India of NFRA, तो definitely sir ये और आगे जाए. So a big round of applause for all the NFRA people, and जो लोग हमारे इतने audience रहे हैं, तो उन सबसे रिक्वेस्ट है आइए ग्रुप फोटो हम लोग कर लें, सो दैट कि ये एक मेमोरी रहे कि हाँ 6 बजे तक हम लोग जो है यहाँ पर पढ़ाई आज करके गए. तो आई रिक्वेस्ट एवरीवन टू प्लीज कम ऑन द स्टेज प्लीज.